Marc also, Chief Economist and Global Strategist, ADM Investor Services. Good morning, Marc, and thank you for joining us.
My pleasure.
So, Marc, first, what's your take on the data, and do you think that the Fed's reaction on inflationary pressures is going to be imminent?
Well, they are definitely. I mean, following on from this, but it doesn't. These two sets of readings that we've had on CPI and PPI really just underline the case that they need to get in front of the curve. There's no question about it. The PPI data basically tells us that we aren't finished yet with pass-through of increases in costs, and that producers are managing to pass through costs to final goods. And that will pass on into consumer prices as we go forward, and it's unlikely to alleviate. So the Fed is expected to double the pace of its taper to 30 billion a month, which would basically bring us to the end of March, and thereafter open up the way to an increase in interest rates. If the signals that we're getting from inflation at the moment are anything to go by, they'll be under a lot of pressure to raise rates by then.
Yeah, and that's for sure. What would you like to hear from them, and what do you think is going to be the market's reaction?
Well, I think the interesting part is, I think what we need to have a very close look at in terms of what the Fed's projections are is not really the dot plot, which is always a little bit of a red herring, particularly as basically the opinions are likely to diverge even more than they have already in terms of an endpoint. But it will be interesting to see what the long-term projections, I think, both for unemployment and for inflation, but also where they see interest rates ending, because at the moment the Fed says the long-term natural rate for the Fed funds is about 2.5. Markets are basically saying, well, this cycle will only get to 1.5. If they were to tweak that higher, that would send quite a stark signal to markets that they are actually quite serious. Or even if it's just a case of projecting for 2023 a rate which is higher than the long-term rate, that would really underline that they do see these inflation pressures as being rather more embedded and sticky than they had previously asserted with their talk about transitory.
Marc, I read something very interesting, because this week is not only the Fed's week, and probably we're going to see more hawkish tone from the Fed, but it's also quite interesting to see what is going to do the ECB and specifically the Bank of England, because last time was a huge disappointment for markets because Bank of England didn't hike rates, but then we saw the IMF, the International Monetary Fund, has urged the Bank of England to avoid inaction bias as it gears up for a key vote Thursday on when to hike interest rates in the face of high inflation. And once again this morning we saw pretty positive, by the way, data when it comes to the unemployment rate in the UK at 4.2%, in line with expectations and slightly lower compared to the previous number. Then we saw the employment change 149k versus 228k. So I was wondering, in terms of Bank of England, what are your expectations, and do you think that if they wouldn't hike rates, a market is going to react once again with massive selling of the sterling?
Well, I think to a certain extent we've got a risk premium already starting to be factored into sterling because of Mr. Bailey's assertion that they don't really want to tie themselves into knots and offer any forward guidance. That basically naturally introduces a risk premium, which has both been reflected in the FX rate and indeed in the interest rate curve, because I don't really actually think markets believe necessarily that UK interest rates will be at 1% next year. They're just, because there is no guidance, that's where they pitched it as a starting point. We'll see where it takes from there. Personally, I actually think the weak GDP numbers that we saw last Friday will play quite a role in the bank's considerations, despite the strength that we saw in the labour data today, particularly the HMRC payrolls numbers, and the vacancies as well were also at a record 1.219 million. But the vacancies are a little bit of a red herring. One needs to think of two things here. One, a lot of the increases in employment that we've seen over the past couple of months have actually been in part-time jobs, which is interesting from the aspect that there doesn't seem to be that much confidence showing up there, which is not really surprising. The UK has a lot of headwinds to the economy, which are more related to Brexit than they are actually to do with the pandemic. The pandemic has sort of helped to cover them up. But I think this time around, there will be looking at the rise in the infection rates, which is accelerating at a fairly alarming rate, though we don't really at the moment know what sort of implications that has in terms of hospitalizations and worse fatalities, which will be an important factor, because at the end of the day, if we get rising infection rates but hospitalizations and fatalities remain low, then there is no real need to lock down the economy in the sort of way that people are worried about. And the bank would be worried about, naturally. But the pressure is definitely going to be on them, particularly if the CPI numbers come in slightly above expectations tomorrow. And the expectation already, and the expectation is 0.4 on the month, which would be a moderation relative to October, which was 1.1 on the month. The year-on-year effects one has to be a little bit careful with, because a lot of it is base effects. But we are likely, as the IMF suggested, to see inflation in the UK around about 5.5% by the early part of next year.
Yeah, which is quite a number.
Yes, and it also puts in some perspective that rise in the average weekly earnings, because it looks quite high at 4.9, though it's decelerating. But it does mean that in real terms, people's pay is actually negative.
Mark, I just wanted to take a step back and just talk about a Fed and what's going on in the US. Why I'm asking, I was wondering whether the stagflation risk is concrete right now or not.
Stagflation risk, I don't really see at the moment. We haven't, outside of Germany, where there does seem to be some demand destruction from all the supply chain bottlenecks, we're not really sort of seeing that sort of impact in the US. I think the bigger part of this is that people need to think about is, a lot of this is about energy prices. And if we go down the route that we're trying to go down in terms of pressure from investors, pressure from governments to exit hydrocarbons quicker, we are at risk of seeing a much, much sharper rise in energy prices. And that's really is something which could actually bring economies around the world to something of a halt, because at some point those rising energy prices are going to prove to be crippling.
So are you saying the most, how can I say, banal meeting this week is going to be the ECB meeting because nobody expects anything?
Well, I think people want to, the ECB meeting is actually very, very important. There's a lot of things
that's for sure
that they could give us indications on. Above all, I think they're going to want to build in some flexibility, because they are also concerned about what might happen in terms of the economic impact of the Omicron variant. But they do need to give us some, they will be updating their inflation forecast. And what we're looking at is something in the region of a 1% rise in headline forecast for inflation, and about 0.3% rise for relative to the previous forecasts. This is for core, but they are likely, nevertheless, to be projecting on the long-term basis that inflation will still be below target, and that will justify them in turn saying that as much as they are going to start paring back the pandemic emergency purchase program, that they will basically be looking at what they need to do thereafter in terms of beefing up the asset purchase program. And the key thing there will be what sort of flexibility they're actually going to build in. Will they allow what would be, say, if they cut to 50 billion, the PEP purchases through to the end of March, they would be left with something like 150 billion, which they could say, if things turn out badly, we can always go back and use that PEP, which would be a dovish note. If, on the other hand, they sound less accommodating on that front, and that when the PEP is coming to an end and they're not going to actually beef up the asset purchase program, the normal one, then that would be taken as a hawkish signal. So there's a lot riding on that ECB meeting, in certain senses, a lot more than on the Fed or even indeed the BOE or BOJ meetings.
In fact, Mark, let me ask you one final take. Do you think that the ECB is supposed to retire the transitory when it comes to inflationary pressures? I shall say here in Italy it's 3.8% year over year. In Germany, I guess about 6%. In France, about 5% or something similar. So, you know, we do see pretty high levels also over here. There is just one problem. I'm talking specifically for Italy, but I guess it's quite the same everywhere here in the Eurozone. So I'm talking about the fact that we have inflation at 4% almost, but at the same time, salaries are not growing. So this is pretty much of a pain, not to mention the energy crunch, the higher prices that we are paying every single month for electricity and gas. So Mark, I mean, do you think there must be any kind of reaction to these inflationary pressures which are in our everyday life?
Yes, well, I mean, the ECB is likely to stress that there is actually precious little that they can do about energy prices, above all the pressure on electricity prices, because it's just not within their remit. It's due to structural flaws in the way that gas is stored. It's structural flaws in grid flows. So it will basically say, probably want to emphasize, and I think for the time being, that the underlying core CPI, which this doesn't help the average citizen across the Eurozone, but nevertheless, underlying core CPI pressures are not really there. And to a certain extent, they are correct about that. But at some stage, there is a genuine risk, and I think we are seeing it already, that permanent rise in energy prices spills over into other prices, because it's part of pretty much every business that one can think of, and then eventually it will have to spill into wages. So they can't be complacent about it, but I think for the moment they are going to basically say, look, we don't actually see inflation being at target in the longer run.
Thank you very much. Great to catch up with you once again. Marc Ostwald, Chief Economist and Global Strategist, ADM Investor Services. Talk to you very soon, and of course, have a great day ahead.